G'day guys, David here from Crypto Consciousness. Welcome back to the channel. Hope you're having a great week of investing. Today, are you interested in knowing the terminology in cryptocurrencies? Are there words and acronyms that you don't understand? Well, hopefully today we can get into some of those and help break up the confusion. Easy to know. First word that we'll start off with the one that most people are like, what is HODL? HODL doesn't exactly sound like something that we normally talk about. So if you look at the word HODL, it comes from the word HOLD, hold, or does it. See, some people think that's a spelling mistake of the word hold. Happened in 2017 and everybody thought they were just repeating it. But the word HODL is a breakdown on the words hold on for dear life. So hold on dear life. That is really what the acronym is talking about. And some people are still confused what it means. It's not a spelling mistake. So just get that clear. But anyway, moving on. ICO is another really important one. Why? Because it's initial coin offering. And in cryptocurrencies, that's when a coin or a project first launches and opens up to investing. And generally it's done through the public, but most of the time ICOs are actually done in private for the bigger investors. They get that done first at a lower price to raise capital, and then they open up to the public, and that's when the public can buy their portion. Generally though, these days it's one of the harder things to get into is an ICO, because what they tend to do is cap the amount you can invest. So it used to be that some people could invest 5,000 or 50,000, but these days there are a lot of ICOs that only allow for $500 or $1,000. And there was one recently that was even $100 because there was so much interest. They wanted to not make everybody disappointed, so they allowed a little bit more of their capital percentages that they had portioned for the sale to be available, but they had to reduce how much each person could have so they could share those funds around the table. You'll find that ICOs are really difficult. There's many platforms these days to get involved with them, but you know there's a lot of rules with them. You have to have a certain amount of funding, certain tokens to be able to access and have be put on the whitelist, which is their list that enables you to go into usually what's a lottery lineup, where you might be first to log in, but you might be given position 5,000, or the person who's 3,000 to log in might get position number 2 or 1. So it's really random like that, but it is so that they can manage the intensity on the platforms that they're using to have everybody log in. They just don't want everybody logging in at the same time, but generally I believe everybody is these days and trying to click and get in as soon as they can and just stay on for the few hours while the sale goes on. Sometimes you have to commit to midnights and 3 a.m.s to stay up for hours just waiting to get into your queue before you can process your purchase. So whether many people won't get into ICOs, they are risky because they are projects before they're launched. Sometimes funds can get locked up for a certain amount of months. For example, the Rally token, it's an NFT play. I got in on that one, but it was easier because it wasn't such a big demand on it. But it will be once it comes out, and they've locked up for 12 months the coin, so that's good. It gives the market a chance to accept it, do its thing, and it is climbing. So it's one of those projects that will probably take a bit more months to get going, and when it does, then you'll still be happy that your funds were locked up. So that's the ICO, initial coin offering, which is equivalent to the stock market, which you can have investors, well, basically companies looking for the public to invest into, which is what you'd see in the stock market as an initial public offering, so IPO. The next one we should look at is what is an IDO. An IDO is when you're initially offering on a decentralized exchange. It says a DEX here, so that's a decentralized exchange. That's what DEX stands for, so it's another acronym. An initial DEX offering as an IDO refers to the launching of a cryptocurrency on a decentralized exchange. There you go. A blockchain project that makes coin's first public debut. So that's there's a few of those exchanges out there. Binance has one, and there's a whole bunch. You can look into them. Next word, which is basically one of the ones I'm really interested in and I have been doing for a few years now, is staking. What is staking? Staking is the process of actively participating in transaction validation. So some people know this to be similar to mining, but it's actually not, because you don't have to be running an algorithm on a computer like Bitcoin. It's a proof of stake, which means you lock up your blockchain, and it basically allows, so you've got a minimum requirement, of course, but it allows the balance to be locked up in that cryptocurrency. So we know that won't have fluctuations in pricing, people wanting to dump the cryptocurrency all at once. And in return, we get the validation that it is locked up, and you get rewards for it. So give you an example. Staking is like putting your money in the bank, once upon a time anyway, when you would have earned a sort of a good amount of interest on it. So 5%, for example, interest, and you just have to leave it in their account, and you wouldn't be able to touch it. If you wanted to take the money out, you'd have to organize with the bank, and you'd get a certain waiting period before you could have the funds released. And that's what staking is. So for example, if you have 100 million tokens and half of those are locked up in staking, you know that the market can't be flooded with all of them to be sold at once. So there's a security behind that, and so you get rewarded for it, and that allows the cryptocurrency to increase in value, because you know you're not going to get a big flood of sell orders. And generally there is a time waiting to get the money back out of staking. So for example, with rYVvK, it's 22 days. That's going up to 30 days soon. That's been voted on by the governance aspect of owning staking your rYVvK. So there's many out there. There's Cardano's, there's Theta Fuel. So there's plenty out there. There's Ethereum and Bitcoin is a very popular one. Now I'll just give you a referral here to BlockFi, which it is a centralized staking platform, which means it's secure and it's gone through a whole bunch of government regulations. My referral code for you to get bonus here is blockfi.com/ref for referral equals E, and the number is 7652548. And that I'll put that into the comment section. But like for example, Bitcoin, you'll earn 5% if you lock it up in there. Ethereum 4.5%, Litecoin 5.5%. You can see here Chainlink 4.5%. So you can get some good returns if you're an investor and you want to just hold, which I do personally in my investment opinion. That is the way to go forward. Just hold your tokens, wait a few years, 5 years, 2 years, 3 years, whatever you can afford to wait. You know, don't ever invest what you can't afford to lose. So if you only have $10,000, then maybe invest 5,000 of it, or 6,000, and leave the rest in the bank, so that you've got access to funds for a rainy day. If something ever happens, you've got backup. So never put your whole $10,000 in, for example, as just a hypothesis. You don't want to put all your money in, because then you're really, really worried if fluctuations occurs. But the good news about staking is that on that 10,000, if you were to take such a crazy risk, then you would be earning 4.5% per year, which brings me to my next acronym. And that 4.5 on 10,000, do the maths, equals $450. Is that correct? Check it out, do the maths, and you'll see. I don't know, I'm just telling you 450 because it seems right. So let's see if that's accurate. Do the maths. You let me know in the comments if I got that one right or wrong. Thank you. Next one, APY. So annual percentage yield is the real rate of return earned on a savings deposit or an investment, for example, in staking, and then you get the compounded interest. So if, let's say, you get paid out weekly, you get your percentage of a breakdown of 4.5, or let's say monthly. So 4.5% is $450 on a $10,000 investment. And so you divide that by 12. That's how much you should be getting monthly. So if you do the maths, I won't do it, but you break that down, that's how much you should be getting to your account. And then you add that in on top of your 10,000, and then it compounds on top of that. So it's no longer just getting return on 10,000, it's getting return on 10,000 and let's say $40. And then the next month, $10,084 or whatever the maths is. And that'll then eventually increase. That $40 will increase to 42, 44, and so on and so on. So you're generating more and more return. So it's a good thing to be aware of APY. When someone says, what's the APY on that? 15% is a brilliant return. I've got one on that. I've got up to 30% on some I've even earned 50% and 36%. Veracity, I earned 36% for the first 2 years. These days, the token value is just, it's something like 60 to 100 times X, which was a really, really good return. And that does happen, but you really need to get in the projects really early to get those kind of movements. Another word that most people don't talk about is whales. Or that you do hear it on YouTube channels, but don't explain to you what it is. A whale is not the animal. They're not referring to the animal in the ocean. A whale is basically someone with a lot of money, millions and millions of dollars, who can flood the market, buy or sell, make many orders, and that'll influence other cryptocurrencies. Or if they're working with one in particular, they'd own millions of dollars of one cryptocurrency, and that can cause excitement on the way up or on the way down. Which brings me to the next word. What is a bull and what is a bear? Again, they are animals, but this is not what they're referring to. Well, they kind of are, but what it does mean, a bull definition is an investor who buys shares or cryptos because they believe the market is going to rise, so going up. And whereas a bear will sell shares as they believe the market is going to turn negative, meaning going down. The other terminology is going long and going short. So going long means you're planning on it going up. Going short, you're trading it to go downwards. When we say sell, you start with a sell order and then you end with a buy order. Rather than if you're planning to buy in and wanting to go up, you start with a buy order and end with a sell order. Either one is the reverse, but it's still opening a position and closing a position, and that's how you have to look at it. Not to get too caught up on it though, because most people who don't know about that shouldn't be shorting anything anyway. Like on Bybit, you should be only buying in on a CoinSpot account, buying in to invest, and then selling it once it goes up and you're happy with the return on your investment. And that doesn't need to be APY because it's not an annual return. It could be a matter of a day or a week, or it could be months. With these kind of markets, in a bull market, you want to be ready to sell if you're not looking at long-term returns. But if you're really not interested in looking at the day-to-day, which can be a bit time-consuming, just buy something that's quality, a good project that you think is going to go up inevitably, for example, like Holochain or Theta or Dent, and buy in, sit tight, leave it for a year, come back, have a look at it. If you're happy with some of the profits, take out your initial capital, and then take a little bit of a holiday, enjoy yourself, enjoy your money, and just make sure that you've got the plan for the next stage of return. So markets don't always go up and don't continue to go up. They go up, but then they don't continue. So at some point they're going to pull back, and so you don't want to lose all your profits. But if you're looking at the really long term, you might want to just say 5 to 10 years, I'll look at it then. And if things are really, really good, you've done well, you might take out half of it and enjoy life, or you might take it all out and just retire. So hopefully you get that. Good luck if you can do it, great. But if you're investing in some of these projects I've talked about on the channel, I think if you put enough money in, because you need exposure, then you will find that there's potential to make significant returns that you would never see in a bank account anymore or any longer. So if you guys want to earn interest and you want to play long, go for it, blockfi.com. If you want to just trade short, like a few months, hold a position and sell it and make whatever you can, there is higher risk in doing that. But with these longer plays, there's a lower risk. Just for example, like Ethereum and Bitcoin, they're both really long-term plays. Theta, Holo, I think they're all projects that are just going to, they're going to have their ups and their downs, but ultimately it's going to ascend in value, in my opinion anyway. And I do hope that you guys can get on board with those. Anyway, I hope this video has helped you with clarifying those terminologies. If there's any others I've missed, pop it in the comment section. Remember to hit like and subscribe to the channel and share to your friends. Share me around. Awesome, guys. Have a happy investing week. And take care, and we'll see you in the next video.